Welcome back here with us on Trading Hour. Markets holding on to its gain. Nifty is closer to 19,800 and 700 today. It's been a very steady morning so far, so good. In fact, at the day's high as we speak right now. Pull up the Nifty gainers. Quite a few metal stocks are having a good run today. Tata Steel, JSW Steel. These are stocks that are doing fairly well for themselves. Hindalco as well, by the way. So metals looking fairly good. And then there's Reliance in terms of the heavyweights, which is helping matters. Amit Khurana from Dolat Capital is with us on this leg of the show for some market perspective. Amit, great to have you here. Thanks for joining in. Hope you had a good Diwali. So tell us, what is the sense on the market as once again it's approaching that 20,000 mark? And also give us the context with respect to the, BFSI turbulence with the RBI slamming the brakes on unsecured lending. So with that piece, because, banks are a very important part of whatever the index is doing, what's your overall prognosis?
Sure. Thanks, Surabhi, and season's greetings to you all. I think there are, to answer your specific question on the RBI move, I think it's a very healthy move. Ultimately, while it does lead to a slowdown in growth estimates for 25 and 26, I think from a more structural perspective, it only strengthens the sector. So while it will lead to some near-term, review of the numbers, some realignments on the multiples that we tend to give to these, banks at large, and balance sheets and credit quality remains extremely healthy, probably the healthiest in decades. But I think this move by RBI from a structural perspective is extremely positive. But markets will realign. I don't have really too much of a concern there. But the greater concern I have is on the expected peak multiples, which were earlier being built in at much higher levels. They will probably get a little bit tampered with, and therefore the muted performance of the banks that we've been seeing for the last so many weeks, and that may very well continue for some more. But again, we continue to be overweight on banks. Remains one of our favorite sectors, and we are playing a basket on the large caps and the mid-sized banks there. From an overall market perspective, let me characterize it. Market is in a classic dilemmatic state. Why I say that? There are enough reasons for large caps to start performing, which they haven't. I mean, in fact, if you look at the calendar year returns, we are trailing single digits. For a year wherein the growth was expected to be much superior, and some of the sectors have delivered that growth. But maybe the performance was largely captured, and therefore the muted returns from a stock perspective. As we head into CY24, my sense is that the first half will probably be large cap performance will be relatively better. That's the base case that we are going in with. And also because mid cap and small caps had done some humongous returns, and some of the sectors have done very well. And therefore, probably it is time for the large caps to start showing some better returns from here onwards. That's the broader sentiment that we are going with.
Amit, real estate, are you overweight?
Yes, we've been overweight real estate, and I think the data has only corroborated that view with the continued traction on the sales data. And this is, remember, still consumption demand. In some pockets, we have seen investor money coming in, but largely, I think the upgrading cycle, the luxury housing and the tier A markets continue to show very strong traction, and therefore we are overweight.
But now you are seeing regional players with pan-India aspirations, right? Oberoi wants to get a pie of the NCR market. Prestige is already making inroads in the Mumbai market. Now, real estate in India up until now has had many micro markets. How easy or is it going to be for these companies to expand on a pan-India basis, or the regions that they've selected? Is there any risk to the company's financials because they're doing it because it's hard to crack into it?
That's a very valid question. I think if you look at it, the last real estate cycle that we saw way back in 2004 to 8 had also similar flavors. But the sector has undergone a significant amount of consolidation, and you typically have the large 8-10 players now controlling all across India markets. And secondly, very important that the regulatory environment, which was absolutely not there, has got much better, alignments, much better, approval status, execution, and the players have also learned their lessons. Now, I would not be able to comment on specific company level risks. There are obviously going to be risks, but I guess that all these developments at the structural level in the sector have made it relatively easier to target pan-India project for some of these, construction, for some of these real estate companies. And balance sheets are much stronger, and the visibility of free cash flows has been much better evidenced in this upcycle. So to answer your question very specifically, yes, there are risks, but I believe that some of the companies which are making foray into it have learned their lessons and are far better prepared to handle forays into markets other than their core strength markets, so to say, and depending upon the viability of the project. Because remember, earlier the real estate companies used to build their entire portfolio at a console level. Now all these portfolios, all these projects are run at individual project level because of the regulatory environment and because of the much higher level of scrutiny by the lenders and the buyers also. So therefore, there has been a sea change, and hopefully the risks will be mitigated much better as we see it.
Okay. Finally, before we let you go, Amit, we're just having a conversation, a discussion on the chemical sector before your segment with a couple of analysts. And one of the views was that perhaps we're at the bottom of the cycle and maybe it's time to start looking at some individual stocks or companies. Where do you stand on this?
Well, we were trying to find reasons to justify that as well in our post-earnings review notes. See, there are two factors there. One, there has been a significant capex done by these companies, which will eventually get capitalized in the next 6 to 12 months. So in terms of the readiness to capture market share at a global level, all the Indian companies are well prepared to do it. The concern we have is that pricing gain is not going to be the driver of earnings. It's going to be volumes. And if volumes turn out to be, shall I say, less aggressive or muted versus the expectations, then FY25 first half could be a challenge. Therefore, a leveraged balance sheet could be risk in some cases. And therefore, at this stage, let me put it this, we've not turned bullish, but we are not as negative as we were a few quarters back. So we are more in the neutral zone. What we have essentially done is we've upgraded Sudarshan to a buy. And most of the other stocks are more in the accumulate, reduce zone. And one downgrade which we had done has been Gujarat Fluoro, which is now a sell. So we would probably wait for the data for the next couple of quarters to sort of evidence this further. But I do believe that chemicals remains a structural story, but there are still enough headwinds or concerns that we have and lack of visibility of data that I would put it like that.
Okay, Amit, thank you for the perspective. Good talking to you today. You have a good rest of the trading session. We need to take a quick break on that note. We'll come back on the other side and, as promised, get you a couple of trading ideas with Mitesh Thakkar.